All right. All right. Hi, everyone. Thank you so much for joining us for our bi-weekly Strategic Partner Education Moment series. I'm excited to bring Mackenzie Bell of Capital Insurance to us this week. Hi there, Mackenzie.
Hello.
Mackenzie is an insurance broker with Capital Insurance, and he's going to be speaking to us today about the pitfalls and things to consider when you're looking for a commercial property. So whether you're a residential agent or a commercial agent, it's still good to have that base of knowledge because no matter what, you're always getting asked questions. So be prepared just to have some helpful tips about what to consider. So Mackenzie, I'm going to pass it on over to you, and now let us know.
Sounds good. Thanks, Alex. Morning, everyone. I'm Mackenzie Bell, and I'm an insurance broker with Capital Insurance Brokers. I do both personal and commercial insurance. However, my main focus is commercial. I've been with Capital for 8 years now, and I've been in the world of commercial insurance for around 6. As most of you are realtors, I will be attempting to keep this on the property side of things only. So, the topics that I'm going to be touching on today, the first is going to be insurance basics. It's just important terms and lingo to know outside the basic knowledge. A hardening market. Most of you know that rates are going up dramatically right now. I'm just going to give a bit of insight in how the insurance market works in both hard and soft markets. Property insurance essentials. It's just a quick overview on the essential coverages that all commercial property owners should have. And pollution is just a quick touch on pollution. I could spend a very long time on pollution, but I don't have that time. So I'm just going to let you know how it can affect potential customers of yours when purchasing a building or land or selling a building or land. So slide 3, Alex, please and thank you. So insurance basics. So the first one here is what insurance is based on. It's called indemnity. So this means we cannot put you in a better or worse place than you were right before the claim. New coverages in the past few years have changed this. You have things like guaranteed replacement cost on vehicles or waivers of depreciation, where we will just buy you a brand new one. So it's a little bit different. For the most part, it's based on the indemnity. So deductible, everyone knows what a deductible is. This is the cost that you pay in the event of a claim before the insurance company will pay. However, in many commercial coverages, depending on the size of the business, it will be based on a percentage, which as you get larger and larger buildings, that percentage goes up and that deductible is massive. You also have to be careful about an occurrence-based policy versus a claims-made policy. Claims-made in some cases is inferior, as you'll need to pay deductible for each claim made. So a manufacturer would not want to have a claims-made policy in case they make an error in manufacturing and have to pay a claim per event, which, you know, if they have a million events, then it's a lot of deductibles and their insurance will be useless. The next thing is co-insurance. So this is a formula put in place by insurance companies long ago to ensure that people don't try and game the system by insuring low and hoping for full payouts on non-total loss claims. Now, just for basic example, if you had $1 million in stock and only decided to insure to 500,000, you would be 50% insured. Co-insurance clause in most companies states that you need to be at least 80 or 90% insured, or you become the co-insurer, which means that you take on the portion that is uninsured. So if you have a smaller claim, let's say 100,000, the company will only pay out the portion that they're insuring, and you pay the percentage that you were insuring, minus your deductibles. The next is minimum retained premium. So this is self-explanatory, but often missed when issuing new policies and miscommunication between broker and client. This is the premium that the insurance company will keep in the event of an early cancellation. A lot of commercial policies will contain 100% minimum retained premium. Again, needs to be noted before the policy is written. In case a client decides to cancel 3-6 months early in, they'll be keeping the full premium. The next is subject tos and warranties. So this needs to be understood by the client and the broker. These get placed in before the policy becomes effective, and once they're into the wordings, and it can greatly affect claim. For realtors, especially on the commercial side, if you're doing a lot of, obviously everything you're doing is brick and mortar, but like retail stores, so this is quite common to have in their policy. It's called an alarm warranty. This states that an active alarm must be purchased and in operation throughout the lifetime of the policy. If a claim happens, let's say a theft claim, and someone steals product from the building, and they find out that there is no active alarm, it could lead a very high potential to having that claim denied. So those are definitely to be watched out for. It is the job of the broker to correlate that to the client and make sure that they are aware of that situation. So next slide, Alex, please. So a hardening market. So it's something that I'm all too familiar with lately. It's been the bane of my existence, unfortunately, as with many brokers. And I'm sure many of you are experiencing the same thing, especially in commercial. The insurance industry is cyclical, fluctuating between a hard and soft market. These fluctuations affect the availability and price of commercial insurance, and in turn also affect personal insurance. A hard market is characterized by a high demand for insurance coverage and a reduced supply of capital. Insurers impose strict underwriting guidelines and premiums tend to increase, which is where we are right now. We're in a hard market, a very hard market. When the market is soft, many insurers are competing for business, premiums generally trend lower, and insurers relax their underwriting and coverage is more widely available. Now, why does the market go hard and soft? Insurers make money two ways. Underwriting profit, obviously this is when premiums eclipse claims and expenses payouts. Investment income, when insurers generate income by short and long-term investments. Because insurers have two sources of income, they can lose money on one and still generate a profit. However, when interest rates are low, underwriters need to pay attention to their underwriting results. Next slide, please. So property insurance essentials. So the basics that most people know about are self-explanatory: is contents, equipment, stock, and buildings. These are all subject to co-insurance and high deductibles for certain perils that I think many of you will see today in commercial insurance, especially with strata policies for condos. You'll see high deductibles for water, especially. That's a major problem with condo corporations right now. And then again, you'll see the percentages for earthquakes. Then you have liability, which is attached to the general liability policy. There's many different types of liability. So you have the general, which is usually for things like slips and falls. So it's property damage and bodily injury. You have professional for people like realtors, insurance brokers, engineers, lawyers. These are results from advice giving. The next is pollution. It's obvious. It's a pollution claim resulting from a pollution event. Again, we can touch on that another time. Management liability, also known as directors and officers liability. So this is a liability claim sought usually due to workplace damages such as improper handling of employee termination. This is also important for boards of directors, nonprofits. This is essential to any sort of brick and mortar store. It's called business interruption. I'm sure most of you have heard of it. It comes in many different options. However, they all have the same premise. They're triggered by a damage to income producing property. Such damage either has to reduce or impair the ability to produce cash flow or increases the cost of doing so. This covers things like profits you would have earned, operating expenses like rent and taxes, reduced revenues from lost tenants, additional costs to avoid shutting down during repair, and additional costs to repair or replace equipment. Coverage is generally added with a 12-month policy indemnity period. However, we usually suggest amending it to 24 months as most claims on a total loss will run much longer than 12 months. Equipment breakdown is another essential coverage for property owners and can be a very costly one if not insured properly. While commercial property policies protect your equipment from losses like fire or flood, they do not provide coverage for equipment failures, such as broken pumps, electrical failure, power surges, motor burnouts, and failed compressors. The examples of the type of equipment that are covered are camera systems, transformers, production machinery, air conditioners, boilers, and refrigeration. This coverage is available both on commercial and personal. A lot of personal home insurance policies are now or have always offered equipment breakdown insurance, which is very nice. So it insures the items for both cost to repair or replace. If we can't fix it, we will pay to replace it. The next coverage is cyber and privacy, and this is a huge coverage today. It's one that I've been pushing on most companies I deal with. So cyber insurance is finding its way into the agendas of most businesses, and for good reason. However, it is still relatively misunderstood coverage, even amongst insurance brokers and underwriters, as it is quite new. It's also a lot different than auto and property, who have been around since, property since the 1600s, auto since the Ford was invented. And so those we've gotten to know quite well. and they're quite regulated as well, whereas cyber is not. It's kind of like the wild, wild west right now, where cyber is different amongst every single company. It's got different wordings, different coverages, and different intentions. Most businesses find themselves confused about how it works and about the many options available, so they usually are quite skeptical about whether it'll actually work for them or if it's worth their time to purchase. Over half of all cyber attacks are aimed at small to medium-sized businesses, and this is due to lack of IT support. They just can't afford the support that the big companies can. And then mistakes due to lack of training. So we all have a staff member that we know that likes to shop online at lunch and maybe isn't computer savvy and might accidentally click a link they shouldn't. Your employees will click on something they shouldn't. It's just the way it is. Every company has them. While you may hear of large claims in the news, you don't hear about the local law firm that mistakenly transferred $100,000 to a hacker after being duped by a social engineering scam. You're only going to hear about the big hotel chain that got hacked. Cyber insurance pays more claims than any other type of insurance. A certain insurer that we have been dealing with for a while has paid more than 1,500 cyber claims in the last 12 months, and a 99% claims payout acceptance. That's the highest percentage of any line of coverage in the industry. The two most common claims we see are funds transfer fraud and ransomware. So most companies think because they don't keep private information or personal information, they aren't susceptible to this type of coverage, where we see a lot of the claims are coming away from privacy and in the cyber world. The next coverage is extra expense. Plain and simple, this is the cost increase to continue business when a claim happens. If your business cannot afford the downtime, they must resume business elsewhere. So next slide, Alex, please. This slide is on pollution. So pollution is far too large for me to go over in a 15-minute speech. However, it is very important for customers to think about when buying or selling commercial property, as well as the realtor who is potentially selling it. Many pollution policies will only respond if a claim is brought by a third party. So what happens when it is found out the land your building sits on is contaminated? Can you afford to remediate the land yourself? No third party, no claim, no remediation, no sale. Your clients need to be aware of the protection historically offered by incorporated entities is also known as the corporate veil, and it can be pierced by a pollution liability event. It will not protect the directors. And then last slide, Alex, please. And as you can see, property insurance is essential in protecting the largest assets that we acquire through our lifetime. So make sure you have a broker that asks the right questions and ensures your clients are properly insured. Generally speaking, a quick policy will not be the right policy. Yeah, thank you very much.
All right, thank you, Mackenzie.
No problem.
I'm just going to bring back up this one. This one has your contact information there, I believe, right?
No, it doesn't.
It does not, but at least they know, at least we can see your name and where you work, so that'll help. But
Yeah.
let me stop this then. All right, so let's go back in. So I'm going to ask you I have a couple of questions for you from some of our viewers. One, when's the best time to bring an insurance broker into the process when either buying or selling a commercial building?
That's a great question. So generally speaking, we want to, if it's an existing company and they're looking at buying and selling a building, we generally want to get into that client 1.5 to 2 months before their closing date, especially in a hard market right now. Like I discussed, the response times from insurance companies, especially in situations like where it's a wood frame building, it's quite a long time. We're looking usually between, depending on it, 15 to 30 days, depending on the operation. Whereas normally it would have been 4 to 5 days on a larger risk, maybe even 6 or 7. So response times have doubled, if not tripled. So I hope that answers it. But yeah, no, definitely 1.5 to 2 months before the closing date is when we want to get in with that client and have a chat, look at their current policy, identify any gaps in it, and potentially move that policy over and add that new building.
Right, and that would be the same on looking at a sale. I'm guessing you would want to take a look at the time of the listing just to make sure that everything's protected, because they may have moved and it might be vacant and those type of things. Okay.
Yeah.
So commercial realtors out there, if you're helping your client buy a commercial property, make sure that they're looking and speaking to their insurance professional at least 1 month to 2 months before possession date. And if you're on the listing side, make sure that you bring that insurance professional in at the beginning of the listing presentation to ensure that they're going to be covered throughout the listing agreement. So what they're selling is still there when the other person comes to buy it. Next question is, can you just explain your process when meeting with either a new business or meeting with an existing business that has an insurance policy somewhere else? And don't worry about time. You can go in depth about how you do your process.
Yeah, no problem. So once an introduction is made, I'll generally try to reach out within 24 hours, hopefully immediately. And then from there, I'll set up a time to discuss their business, their operations, what they're doing, what they're looking for. I'll ask for generally a copy of their current policy. Once I have that, I can identify any sorts of gaps in insurance. That's generally where I get a lot of my clients from, is poking holes in their current policy. Quite often I find that they're underinsured or improperly insured, or missing some basic coverages that are very important that they may want to look at and maybe haven't been identified. Once, let's say they're buying a new building, I will request some information on the building, usually pictures, appraisal if there's an appraisal, inspection. And then I'll walk through the client to determine what sort of coverages they're looking for, what's available for them. And then I try to set an expectation with the client, especially today. That's one of the most important things, is trying to set the expectation that things are going to take longer than they normally do. Now, that's tough to do sometimes because there's quick possession, which I'll do my best with a quick possession, but I'm at the mercy of the underwriter. So if the underwriter has determined that maybe it's not the best risk coming in, like let's say there's some deficiencies with the building, it may get pushed to the bottom of the pile.
Everyone feels your pain on underwriters. Mortgage underwriters, insurance underwriters, everyone feels your pain when it comes to
damn underwriters. I love my underwriters. Yeah, so generally what I'll do is I'll ask for a copy of the current policy. I'll go through it in detail with the client. I'll set up my own submission with them, and then we will approach the insurance companies from there and hopefully be able to identify gaps in their current, fill those gaps, and get the insurance transferred over and the new building or location properly insured.
And then do you do annual check-ins to see if the policy is still the correct policy?
Yep, so we get renewals generally, again, due to our time right now, some renewals are coming in quite late, but generally we should be getting them a month and a half to 2 months out. We've been seeing some renewals coming in only 30 days out, unfortunately, but that's a little bit out of our hands, as long as the broker's gotten all the information in correctly. But what we'll do is once that's in, we will review the policy, call the client, ask for a review on the policy, make sure that all of his limits are correct. In commercial, there's no such thing as guaranteed replacement cost. I mean, at least with our companies. So we want to make sure that the property is properly insured. There is inflation usually with most property policies where the company will inflate it a little bit every year. But again, it's always good to have a review for both operations, gross revenue, especially gross revenue right now. A lot of companies have dropped their gross revenue quite a bit, and it's important to identify that dropped gross revenue to identify a possible premium reduction when it comes to their liability. Home insurance, most homes will have guaranteed replacement cost on them, meaning that regardless of the actual cost to replace the home, the company will replace it as long as it has a properly done evaluation along with the submission. Whereas in commercial, we need to ensure that that building is always 100% to its value. If it is below that, you're going to suffer the co-insurance penalties that we chatted about earlier.
Right. Mackenzie, I'm going to ask you, when this is done, to just tag in your actual contact information into the Facebook post. So then that way people will know how to get a hold of you.
Yeah, for sure.
It'll be important to reach out, because everyone, Mackenzie, does do home insurance as well as commercial insurance. So just to give them a final peace of mind, just to know some of the insurance companies that you are able to offer through on the commercial side. Can you just list off some of your bigger ones?
Yeah, so we have most of the largest ones. So we have Intact, we have Aviva, we deal with Economical, Wawanesa, Peace Hills, Optimum West, Saskatchewan Mutual, and those are our main companies, the direct companies. Now we do also have some what are called MGAs, so managing general agents, which we have access to. The bigger ones there would be Premier Marine, or Premier Canada, they're called now. Chutter, April Canada. We have access to Guardian. There's probably about 30 or 40 MGAs we have access to.
Nice. Yeah, so definitely have, regardless of the client situation, you probably have someone that they can go with or that will be able to help them out.
Hopefully.
Yeah. Well, awesome. That is all the questions that we have. So thank you so much, Mackenzie, for joining us today and enlightening us a little bit about commercial real estate and the pitfalls to watch out for when looking at a commercial building. I'm assuming a lot of these also apply to whether you're leasing or whether you're purchasing. Yeah, it's the same pitfalls to watch out for. Thank you so much. Any last words for us before you go?
Nope. Thank you very much for having me out. I will post my information in the Facebook post that you've done, that you've tagged me in, and then if you need to contact me, my information will be there.
Awesome. Okay. Thanks so much, guys. See you, Mackenzie.